All right, let's dive into a masterclass from one of Wall Street's absolute legends, Peter Lynch. We're going to crack open his classic book, Beating the Street, and figure out how you can actually have an edge over the pros. You know that feeling? Like Wall Street is some kind of rigged game where the professional money managers with their supercomputers have this advantage you just can't beat? Yeah, you're not alone. But Peter Lynch, and this is the guy who grew the Fidelity Magellan Fund from $20 million to $14 billion, he says that feeling is totally wrong. He's got a secret that pretty much flips that whole idea on its head. And here it is. This is the big one. Lynch argues that you, the regular person, the amateur, you have a built-in advantage. You can spot the next huge stock, what he calls a 10-bagger, long before the so-called experts on Wall Street have a clue it even exists. So, how did Lynch prove this wild theory? Well, it wasn't with a team of PhDs or a bunch of market wizards. Nope. He used a group that Wall Street would never, ever take seriously. Get this. He tells this incredible story about a social studies class at St. Agnes School. We're talking 7th graders, and their assignment? Manage a stock portfolio. No complex algorithms, no fancy charts, just their own observations about the world around them. And the results? They were just staggering. A 70% return in only 2 years. I mean, they didn't just beat the market, they absolutely demolished the performance of these geniuses who are managing billions of dollars. So Lynch asks the billion-dollar question, right? The kids picked companies they knew, stuff that actually understood, like Disney and Nike. It seems so obvious. So why did the professionals, with all their research departments and all their resources, completely miss them? So that's the big question, isn't it? What was the secret weapon these kids had? It wasn't some supercomputer. It was an advantage that every single one of us has, right now. Their secret was, well, it was the real world. This really gets to the core of it. While the Wall Street pro is stuck in an office, buried in spreadsheets, you're out there living in the real world. See, your big advantage is your own experience. When your kids just can't get enough of some new toy, or you notice a new coffee shop that is always packed, that's research. You see these trends on the ground floor, months, maybe even years before they show up on some financial statement. And listen, this isn't just some cute story about a bunch of kids. The hard data totally backs it up. Back in 1992, almost 70% of amateur investment clubs in the US did better than the S&P 500. Amateurs, using their local, on-the-ground knowledge, were consistently beating the pros. And this whole idea of keeping it simple, well, it builds directly into Lynch's most famous rule. A principle so clear, a child could use it. And that's exactly the point. This is the famous crayon test. It's brilliant. If you can't explain what a company does in super simple terms, simple enough that you could draw it for someone, then you have no business owning it. It just cuts through all the jargon and forces you to invest only in what you truly, truly understand. So the process Lynch lays out is pretty simple. Step 1, spot it. That's you using your everyday advantage. Step 2, do the homework. This is so important. Just seeing a popular store isn't enough. You gotta check if it's a healthy business. And then, step 3, follow the story. Investing isn't a set it and forget it kind of deal. You have to check in, make sure the reasons you bought the company are still true. Just look at this comparison. It says it all. The St. Agnes kids, they picked stuff they used. The Gap for clothes, Nike for sneakers. Simple. Easy to understand. Meanwhile, what was the one real dud in their portfolio? IBM, a classic professional stock that all the grown-ups kept buying and then kept wishing they hadn't. Okay, so even if you pick all the right stocks, you're going to face your biggest enemy, your own brain. Lynch says the biggest danger is what he calls weekend worrying, where you just have way too much time to get scared by the news. Depression ahead, trade deficit doom. I mean, you see these panic-inducing headlines all the time. Lynch talks about going to these big round tables with other top investors, and their predictions were just all over the map. And usually, they were dead wrong. All this noise, it's designed to make you panic and sell at the absolute worst possible time. And this chart, this shows you exactly why you have to ignore all that noise. The long-term data is your anchor. I mean, think about it. Despite 70 years of scary headlines, stocks have returned about 11% a year. That's more than double what you'd get from safer stuff like bonds or CDs. And this highlights a really critical point. Being a great investor isn't just about analyzing numbers. It's about having faith. Faith that, despite all the crises and recessions, the bigger picture for the economy is one of progress and growth. That's what gives you the guts to hold on and really get those rewards. And that brings us to the final, most important takeaway here. Investing isn't about getting rich quick. It's about letting great companies do the hard work for you over the long haul. You know, people always think they have to get in on the ground floor. Lynch shows us that's a total myth. Even if you bought Walmart a full decade after it went public, after it had already gone up 20 times over, you still could have made 50 times your money over the next 11 years. And here's another one Lynch mentions from his own career. Albertsons, the grocery store chain. It became a 300 bagger. That means for every dollar you put in, you got 300 back. That's the life-changing power of finding a great company and just having the patience to let its story play out. This is one of Lynch's most powerful rules, and it's so smart. Instead of always chasing the next new thing, you should focus on the great companies you've already found. If their story is still getting better, then adding more money to that winner is often the best move you can make. So, forget the talking heads on TV and all the complicated financial reports for just a minute. The next time you're out and about, at the mall, in a restaurant, or trying a new product, just ask yourself, could this be the next big winner that Wall Street hasn't even noticed yet?